Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 15th, 2023. Hope you're doing well. Thank you so much for tuning in, and I hope this new edition of Gossett Trading and Mentoring Weekend Review is going to be helpful for you. Here is the format for today's program. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We are going to take a look at all the trades that I made last week, both on the daily and the weekly charts. We're going to talk about when I placed the trade, why I placed the trade, and most importantly, how I am going to manage the trade going forward. So we'll go through all those. Hopefully that will be helpful, be able to get an idea of what I'm looking for. In general, when I look to make a trade, I'm looking for some kind of rejection of some lower level if I am wrong, some key level like the 30 RSI, the 200 SMA, the 250 SMA, the 300 SMA. Then I position size based upon the current market volatility. I place my emergency stop. I know where my end of day stop. If the market moves in my direction, I start to take partial profits when it moves up a amount of 0.45 ATRs. Don't take the whole position off, but just partial profits as it moves up. I look for key levels to initiate a trailing stop mode, and then also some significant overhead resistance levels. If it's rejected, then I take partial profits and so forth. But I'll go through all of that when we get into the trades. After the trades, we're going to talk a little bit about trader psychology. Always the most important skill in trading that you can develop is the skill to place your trade, have your plan, follow your plan like a robot with laser beam focus. It really is important that you have a process that takes into account where resistance levels are, what you're going to do. Getting into a trade is easy, but managing the trade, that's where the people that make money compared to the people that lose money are separated. And I have spent 28 years working on processes and rules so that I just have a paint by number mechanical type of approach, and it has to encompass good trading principles, looking for those resistance levels, playing offense and defense in your trade so that whatever the market does, you know what you're going to do, because we cannot control the market, obviously, but we have to be able to control what we're doing. So creating a plan, following the plan falls under the heading of trader psychology. It's so important, everyone. And if you want to be a better trader, you've got to get that process in place, and you have to have the guts or the strength to follow it. So we'll talk a little bit about trader psychology. Today I'm going to actually talk a little bit more about just some good trading words of wisdom, but they all kind of fall into the same category. All right, after that, we are going to do a quick poem for my friend Frank. He's the trading poet, great poet, great author, great trader, journalist, and he writes great poems, and we're going to touch on one of those, always pertinent to what's going on in the market and some good advice. After that, I have gone through my master watch list, and I have identified some potential trades for myself next week, both on the daily and the weekly bars. Almost always when I do this podcast and I talk about potential trades in the future for myself, they're not there yet. They either have to go down further or they have to go up further for a momentum trade. So I like to trade multiple time frames, like to trade daily, weekly, even monthlies. But for today, I have identified some potentials for next week, both on the daily and the weekly chart. So I hope it's helpful for you. I hope it gives you an idea of how I look at trading, look at those support levels and confluences and combination of signals, not only on one time frame, but on multiple time frames. And so I'll point those out when we get to that point. All right. So hang tight. I'm going to run the U.S. legal disclaimer. I will be back in about 40 seconds. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Alrighty, thanks for sticking through that with me, and let's get started. Okay, first on the dailies. DIA, which are the diamonds, the Dow Jones Industrial. A little earlier, I talked about buying at support levels, seeing some kind of major support level rejected. This is exactly what happened on this trade here on the Dow. I bought this back on the 28th of March. Here's the 200-day moving average, significant level of support and resistance. Bought it here. The previous day before or 2 days before, we were under the 200. We closed back over the 200. I didn't buy it there. Next day we came down, we retested it, and it went below the 200 during the day, and then it closed above the 200 at the end of the day. I always make my buying and selling decisions for swing trades at the end of the day. I believe the end of the day is the most valid price of the day. That's when the large financial institutions come in that last hour, and in particular in the last 10-15 minutes. I believe that is the most valid price because they are dealing with the most money. They have very smart people, best technology, and I think that the end of the day is my preferred time to make my final decision for my swing trades. So during the day, we went under, we closed back over. I got long here, DIA at 323.90. Now, at this point, when I see this trade, I have to decide, okay, how many shares am I going to buy? And I will, in a little bit later in the podcast with the new trade, I'll show you exactly the math of how many shares to buy vis-a-vis what your account value is. And so that's where I place the trade, enter the amount of shares that formula tells me. Now, at this point, I have two stop losses. I have an emergency stop loss way down here, and when we get to the new trades, I'll show you exactly how I do that. That seems a long ways away. It's very unlikely that this will be triggered, but it's possible. It certainly is possible. About 5% of the times you will hit your emergency stop. 95% of the time you will use an end of day stop. Well, my end of day stop, why did I take the trade? I took the trade because we went under the 200 and then closed over the 200, giving me support of the 200 below. Now, the next day, if it had just simply closed below the 200, even by a penny, I would just be out of the trade. You see, that gives me a very, very good risk to reward ratio. I need to use the emergency stop in case everything hits the fan, right? Bad news, something like that happens. I need to have a point where I say, okay, I'm wrong. But my end of day stop, 95% of the time, that is going to be the one that I will take a loss on. And if I take a loss, this one, obviously very, very nice game. But if it had closed below 200, I'm just out. All right. So we're dealing with the emergency stop and the end of day stop. Now, to the upside, if I am right, I always place a 1.5 ATR trailing stop above my entry. This is 1.5 ATRs above my entry. If it gets there, then I go into trailing stop mode. Also, as it moves up, mentioned a little while ago, when it moves up, the value of 0.45 ATRs, right now it's $1.69. When it moves up the value of 0.45 ATRs, I take 10% of my position off. I like to sell into strength. So you can see, bought here at 323.90. Next day moved up. It did move 0.45 ATR, so I took 10% off. Next day moved up again, took another 10% off. Next day moved up 2 ATRs, took more of the profits off. You know, in sports, you need to play offense and defense for any championship team. In trading, I believe it's the same way. The defensive moves are your positioning, your end of day stops, your emergency stops. As it moves up, like to take partial profits. though that is my offensive move. Here on the 31st, I got to trailing stop level. Now I go into trailing stop mode, which simply means if I have a close below a previous bar's low, I will get out. Well, it never happened. Here we went below, but we didn't close below. So I kept the trade. Then we had some consolidation here. We had another up move, took some more profits, took some more profits. Now, the levels that I'm looking at this point are either the 70 RSI. So if I were to reject the 70 RSI, right now we're at 63.16. If I were to reject the 70 RSI, I would take half of the trade off. And then after that happens in the future, if I have a close below a previous bar's low, I'm just going to get out of the trade. Now, we're at 63.16. We are not at the 70 yet, but another variable, another rule comes into place here, because if I get above the 65 RSI ever in the trade, and right now we're at 63.16, the previous day we were at 65. So whenever I reach 65 at any point during the trade, then my 5 EMA comes into play. And if it were to close below the 5 EMA, I would be completely out of the trade. During the day on Friday, it did get below, but remember, I wait for the end of the day to make my decisions, and it was strong enough to close back above. So from here on out, this is a very, very easy trade to manage. If it moves up, I'm going to continue to take more profits. If it rejects the 70 RSI, I'm going to get out of half. After that, if I have a close below a previous bar's low after that, I will be completely out of the trade. Or simply, if we close below the 5 EMA, I will be out of the trade. So this has been a beautiful trade on the remaining shares that I have left. This trade up 4.33%, which is a big move on an index. So hope that made sense. And this one is just on autopilot. And if it closes below the 5 EMA, I will be out. But this trade, really nice one. But you can see, look, what was my risk? I mean, my ultimate risk was down here, but my end of day stop, it just simply a close below the 200, I would just be out of the trade. And that's what's important in trading, everyone, is setting up a good risk to reward ratio. So if you're wrong, most of the time you're wrong small. But if you're right, something like this, that's how you make money in trading. And in this podcast, I do my very best to show you my rules, show you what I'm doing and how I'm trading and managing this. But there are a lot of rules. I'll be honest, there are a lot of rules, and I do offer a one-on-one stock trading course in the evening time via Skype. It's a great course. In that course, I teach you all 5 of the different trading approaches that I use, and more importantly, I teach you all the rules step by step, and we go through back and forth. We do a lot of simulation trades so that by the time you're finished with this course, I know you know how to trade. I've taught people from all over the world for many years. It's an investment. It does cost $1,750, but it's an investment in learning a skill. So if you are interested, my email is in the link of this description. All you have to do is reach out to me. We can have a Skype call. I can answer all your questions. And, if it feels like it's the right thing, just go ahead. You can email me back after we're done with the call and say, Greg, I'm ready to go. And I promise you, you will be happy that you took this course. It's very important to me that my students succeed, learn all the rules, and if you do, you'll have a skill that you can use for the rest of your life. All right. So that's DIA. Current remaining shares up 4.33%. All right, Home Depot. Well, with the market moving up so strongly, there's not a lot of good long setups at this point. I mean, I have some that I'm going to go through later in the podcast, but I have been turning my attention to some shorts as well. And this one has worked out very well. Now, in the previous example, I talked about a rejection of the 200 from the long side. Well, this is the opposite. This is a rejection of the 200 to the upside. So this was a short position. You can see I shorted this back on the 4th of April. But the day before, we closed above the 200-day moving average. Don't want to short there because now the 200 is support below. The next day, we closed back below the 200. We also had a V1. Speaking of V1s, V2s, I use these all the time, and I have a great video. It's completely free. It's on my YouTube channel. Just go to my lessons playlist on my YouTube channel and look for V1s, V2 entries. They're a big part of my trading. I believe they add a lot of value and they increase your chances of having a profitable trade. And so on the day that I shorted this, we had a V1. Here is bar 1, here is bar 2. Bar 2 went above bar 1 and then reversed back down, showing that there were no more buyers at this level. So bar 1, bar 2 goes above bar 1's high, closes below bar 1's close, and in addition to that, close over the 200. And in addition to that, this level, I like to look at multiple time frames. This level, and I drew the pink line here. If we look at the higher time frame, I know this looks a little cluttered, I apologize, but on the weekly, you see the 50 was a major level of resistance. And so on the day that I took the trade with the V1 to the downside and the loss of the 200, that level, the pink or purple line there, also rejected the 50-week moving average on the weekly charts. So I like to look for confluences, combinations of indicators and multiple time frame levels, and that's why I took the short here at 295.10. Now, as always, I position size based upon the volatility of the market. I placed my emergency stop all the way up here. That's my emergency stop. If it got there, I would just simply get out, and I would have a fixed amount of money that I would lose, and I'd have to be okay with that. Now, end of day stop is simply a close over the 200-day moving average. I placed my 1.5 ATR trailing stop level 1.5 ATRs below. As it moves down, the value of 0.45 ATRs, I take partial profits. So got short here, 295.10. Next bar moved down strongly in my direction. I took 2 profit targets off, locked them in. Next day, got to trailing stop level, also moved down, took more partial profits on weakness. Now, once I reach my trailing stop level, if I have a close above a previous bar's close, I will get out of half of the position, which is what I did. And the first half, let's see. Yeah. The first half I locked in a 1.34% gain. Took that off the table because it started to move back up. And then the next day moved up again, went against me. Next day I was like, uh-oh, this is looking like I may have to get out. But you can see I wait till the end of the day, right? So it was above the 200, then it had a huge reversal to the downside, hit another profit target to the downside. Thursday down again, took more profit targets, locked them in, and then Friday we were up. But so far, really good short trade here. The remaining shares that I have on Home Depot currently up 0.99%. So nice little trade, and I like to have the balance of some longs and some shorts. In general, right now, long term, I am bearish on the market. Doesn't mean I'm just going to go ahead and short everything. I have to have proper setup, everything I discuss, all the requirements. But in general, I am short here, and when we go through what my potential trades are for next week, there are some longs, but there also are some shorts too. So on Home Depot, the short current, the rest of the remaining shares that I have up 0.99%. Caterpillar, long trade. Why did I buy it? Pretty obvious. Here's the 200-day moving average, important level. The previous day, I bought this on the 10th. Previous day on the 9th, we closed below the 200. Next day, we closed back above the 200. Now I have the strength of the 200 above me. Main reason I took the trade. Secondary reason I took the trade, here's a V2, but here is to the upside. Bar 1, bar 2 goes below bar 1's low and then closes above bar 1's close. So I have a close under, close over the 200, and a bullish V2. I got long here, 214.88. I position size based upon the volatility. I placed my emergency stops 2 ATRs below my entry. My end of day stop is simply a close below the 200. I place my 1.5 ATR trailing stop level above. So if I reach that point, now I go into trailing stop mode. The next day moved up. The offensive part is I'm going to take partial profits, which I did. I hit 2 profit targets on that day, took that in, locked it in the bank, reduced my position size. Market can't take it away from me, but I don't want to sell it all. Have not got to trailing stop level until Friday. Doesn't have to close above trailing stop level. It just has to hit it. So now I am in trailing stop level, which means if I have a close below a previous bar's low in the future, I will sell half of what I have remaining. If it keeps moving up, I'll continue to take profits. I'll be looking for that 70 RSI level. I'll be looking for it to get to a 65 RSI level. Then the 5 EMA will come into play. You can see I have earnings out here on the 26th. I never hold through earnings, everyone. It's a great way to make a lot of money quickly, but it's also a great way to lose a lot of money quickly. And our main focus, our main responsibility as traders is as a risk manager. That's our main thing. We have to manage risk. We have to think about risk first, and holding through earnings is not a good way to manage risk. There's too many unknowns and too many unknown variables. So regardless of whether this trade's way up here or down here, if it's under the 200, I'm out, right? Because that's my that's my end of day stop. But regardless of where it is or what it's doing, I will exit the day before earnings. So this particular trade doing nicely, up 3.91%. All right, here we go. Now, these are some daily trades that I got out of last week. Bought UAL, United Airlines, back here on the 27th. Very similar to what I just showed you in the previous trade. Close under, close over the 200, and a V2. Got long here, 41.80. My end of day stops closed below the 200. My emergency stops down here, 2 ATRs below. Here's my trailing stop level up here, 1.5 ATRs above. Next day, moved up a little, no profit targets. Next day, moved up more profit targets. Next day, moved up strongly. Took some more profit targets, got to trailing stop level. Here's our first close below a previous bar's low. I locked in half of the profits that I had remaining. That wasn't a good sign with the close under the previous bar's low after reaching trailing stop level. Then we had another down leg, no profit targets. Here we closed below the 200. I thought, or we got below the 200 intraday, but it closed back above, so I continued to hold it because that's my end of day stop. Next day moved up a little, no profit targets. Next day moved up a little, no profit targets. Next day moved up strongly, took some more profits off. Next day, boom, had some news, closed below the 200-day moving average. Oops, sorry. So on the remaining shares, I took a small loss, but all in all, it was a very profitable trade because the fact that I started to take, I took partial profits on strength. I had a trailing stop here where I locked in half at a profitable level, then took more off on strength. So all in all, on the remaining shares, I lost 0.87%, very small loss, totally fine. But big picture, it was a profitable trade because of the importance of taking partial profits when the market gives them to you and having a trailing stop method to lock in profits. So the remaining shares here lost 0.87%, but overall profitable trade. And then Verizon, this was kind of a nothing burger, but I did short Verizon here when we rejected the 200-day moving average. I got short at 39.48, placed my emergency stop 2 ATRs below. My end of day stop is simply a close over the 200. The next day moved down my way. Did take some profits, which is important. And then the next day we closed back above the 200. But the close above the 200 was lower than where I shorted it, so it was a profitable trade, almost a scratch trade, only a profit of 0.08%, but I had to follow my rules, get out with the close above. All right, so those are the daily trades. Quick recap: DIA up 4.33%, Home Depot short up 0.99%, Caterpillar up 3.91%, UAL took a small loss of 0.87%, and Verizon small gain of 0.08%. All right, let's get over to the weekly trades. Now, weekly trades I take on Friday because that is the end of the weekly bar. Here is Tesla. We had a nice move up over the 200. We had a pullback and rejection on Friday at the close. With the close back over the 200, I got long here at 173 even. Next week, moved up. No profit targets. Next week, moved up my way, took off some profits. Next week, moved up again on strength, took profits. Now we've moved back down. We did have a close below previous bar's low, but that doesn't come into effect because I never reached my 1.5 ATR trailing stop level. This week, we tested the 200 again, was able to close back above. We do have earnings coming out here on the 19th, so in that case, I will get out the day before earnings happen, again, because I do not want to sit through earnings and all the volatility and risk that that entails. But so far, this trade is up 6.9%. Pretty good. IWM. All right, I have been in this trade for a hot minute, everyone, but it's been a good trade and it's a good teaching example. I bought IWM Russell 2000 back here on the 14th of October 22, back when everyone was very, very scared, but I didn't let that get to me. I go off of the technicals. And what were the technicals? Well, here is the 300-day moving average. Very important level. During the week, we went way below the 200 and then closed back above. Well, that is my entry point. I position size. I place my emergency stop 2 ATRs below. My end of week stop is simply a close below the 300. I place my trailing stop level 1.5 ATRs above. Again, as it moves up, I take partial profits. Next week, moved up, took some profits off, took some shares off. Next week, again, moved up, took some off with the strong move. Next week, we came down, no profit targets next week. Nice, huge, big up bar, took more profit targets, got to trailing stop level. After you get to trailing stop level, if you have a close below previous bar's low, get out of half. I got out of half here with a close below the previous bar's low. That was, let's take a look. That was a gain of 6.29% on half of the remaining positions. Moved down, I thought, oh, we're going to revisit that 300 again. Never did. Had another upswing in the market, so I was able to take off more profit targets. Here, took off 2 nice profit targets. Here, took off 2 nice profit targets, all in profitable levels, and then we came back down, right? So you see, it's important that I took those profits when I had them, and we still have been able to hold the 300-week moving average. Again, if it closes below the 300, I'm simply out on the remaining shares. I don't have a lot of shares left because of all the profit taking I took here, and I took here, and the taking half off here with a close below on the trailing stop. But very easy trade at this point. If it continues to move up, I'll just continue to take partial profits. If it moves down, closes below the 300. The 300 is above my entry price now, so almost guaranteed a profitable trade. I mean, I can't see any scenario where this wouldn't be a profitable trade because all the positions that I took off on strength. If it continues to move up, again, I'll take partial profits. If we get to a 65 RSI level, then the 5 EMA will come into place. If we reject the 70 RSI, I'll take half, and then if I have a close below previous bar's low after reaching the 70 RSI level, I will get out of half. Listening to myself speak here, I know that sounds complicated. It's really not that complicated. But there are a lot of rules, and again, in my one-on-one course, I teach you all these rules, and if this sounds complicated to you right now after taking the course, I promise it won't be, because we will go through so many simulations that you will have it down. But the remaining shares left on IWM, still doing nicely, up 5.3%, not too shabby. XLF, nice trade on XLF. Again, why did I buy it? Well, this is a weekly trade, bounced at the 250 level. There were no more sellers at this point. That's why I bought here at 30.71. Emergency stop 2 ATRs below. When do I get out of the trade? Where's my end of week stop? Simply a close below the 250. Never got there. Placed my 1.5 ATR trailing stop level above. So I got long here, 30.71. Next week moved up, took some profits off. This week moved up, took some profits off. I am at trailing stop level now, which means if I have a close below a previous bar's low, I'm going to get out of half of the trade. This particular trade, entry to current price, up 6.72%. Really nice. Boeing worked out well. This is a short trade. I shorted Boeing last week at the close at 214.12. We rejected the 200-day moving average above, and we had a V1, back to the V1s, V2s. We had a V1 to the downside. So I like the confluence. Short position, place my emergency stop 2 ATRs above, and where my end of day stop or end of week stop, in this case, simply a close above the 200. I place my 1.5 ATR trailing stop level below. Still not there yet, but this week went down. Did take some profits on the weakness because this is short. This particular trade currently entry to current price up 5.52% on this short. Pretty sweet. And then last but not least, I initiated a new short position in AGQ. AGQ is double leverage silver. If you've been listening to this podcast for a while, you know I have been kind of stalking this trade, waiting for, being patient, waiting for it to do what I wanted to do. Well, here we go. On the weekly, we went above the 200 during the week. Market couldn't hold, came back down, closed right below the 200. I got short 34.60. You can see the 200 is 34.66. Had it closed above 34.66, I would have not gotten into trade because now the 200 is support, but it did close below, so 200 is resistance. So I position size, place my emergency stop 2 ATRs above. If it closes above the 200 next week, I will simply get out of the trade. I place my 1.5 ATR trailing stop level below. Now, I told you about position sizing, and let me explain. So this all has to do with what your total account value is. Let's just take a hypothetical $100,000 account. 1% of that is what I use, 1%. So $100,000, 1% is $1,000. So I take $1,000, I divide it by the value of the 2 ATR. This helps me adjust for the volatility of the market. Divide that by 6.69. That tells me to short 149 shares. Doesn't sound like a lot, but there's a lot of range in a weekly bar. So I short 149 shares here. Now, my maximum allowed loss was $1,000, right? So doing this math, taking 1,000 dividing by the value of 6.69 shows me to buy or short 149 shares. That's why I placed my emergency stop 2 ATRs below. So if 149 shares moves up to 6.69, then I lose the dollar, right? But my end of week stop is a close above the 200-day moving average, and right now we're under. In addition, I drew the line here of my entry price. Do you see the resistance here of the 100 and the 50? Those are significant levels also here. We have a gap here. If you follow ICT methodology, here is a gap as well after taking out this swing low. So we have this gap here, which generally that's also going to be a resistance point, and that dovetails with the 100 and the 50. And also on the weekly, the market showed it did not like any prices over the 200 week. So this is the new trade here. If next week it closes above the 200, I'm simply out. If it hits my emergency stop, obviously I'm out. If it moves down, I will cover part of my position of next week. If it moves, right now the 0.45 ATR is $1.50. If next week it moves down $1.50, that's where I will take off 10% of my position size and lock in profits on strength. So hope that makes sense. Just a quick review of the weeklies. Tesla up 6.9%, IWM up 5.3%, XLF up 6.72%, Boeing the short up 5.52%, and AGQ basically exactly even because I just took that trade on Friday. So all in all, really good week. Very happy with my positions, both long and short. And like I said, when we go through potential trades for next week, there are some longs and some shorts, but I'm becoming increasingly a little bearish here. But again, that's kind of my, that's just my opinion. That's my sense. But as always, I still need to use proper signals. And if I'm looking for shorts, I'm looking for rejections of levels above, like I just showed you on silver. So, all right, let's talk a little bit about trader psychology. You know, it's so important to be able to follow a plan, create a plan, and then follow that plan. It's a skill, everyone. It really is a skill. And trading is a skilled occupation, both technically and mentally. But today, these not so much trader psychology, but more trading words of wisdom. This is from Black Swan, founder of Trade Hubble. Love this Twitter channel here. Please follow Black Swan, founder of Trade Hubble, does a really good job of posting some good information. And this is Jesse Livermore quotes. Jesse Livermore, if you've read the book Reminiscence of a Stock Operator, which I have, which is one of my favorite trading books, Jesse Livermore was a wildly successful stock trader back in the early part of the 1900s. And he has some really good information here, some good trading words of wisdom, if you will, general trading information of proper trading. And I thought this would be helpful. I enjoyed reading it and thought it would be helpful for you. Buy rising stocks and sell falling stocks. Always better to buy rising and falling. However, the way I trade, buying fear with a proper signal like a 200, 250, 300 SMA or a 30 RSI, you can see from the trades that I just showed you, buying fear, in my opinion, is one of the most profitable trading approaches. When everyone's dumping to buy into that, as long as your technicals support that. But if you don't have a system, if you don't have an approach like I do, I agree with Jesse Livermore. Buying rising stocks and sell falling stocks as a general rule is a good idea, but I approach it a little differently by buying fear with tight stops, proper position sizing. But in general, yes, buying rising stocks and selling stocks. Do not trade every day of the year. Yeah, you don't have to trade every day. You have to be patient and wait for the setup. Patience will put a lot of money in your pocket. Just like that AGQ trade. I have been looking for that AGQ trade for months, and it finally hit. Doesn't mean it's going to be a winner, but I was patient in letting it come to the spot that I was looking for. Okay. Only enter a trade after the action of the market confirms your opinion. I completely agree. And on my deep dip buys with rejections of 200, 250, 330 RSI, I look for a rejection of that level, or in other words, I enter the trade after the action of the market confirms my opinion. Continue with trades that show you a profit and trades that show you a loss. Couldn't agree more. If they're moving your way, I like to take partial profits. I stick with them. I'm patient. But if they show a loss, or in other words, if it closes below my end of day or end of week stop, I am immediately out. But very, very good. It's a very, very good approach to be very patient with your winners, very impatient with your losers. And the way I structure trades with emergency stops, end of day stops, with good risk to reward ratio, that I'm doing exactly what Jesse Livermore says. Continue with trades that show you profit and trades that show a loss. And trades when it is clear that the trend you are profiting is over. That's true. Well, how do you know that? Well, there are certain levels like the 70 RSI level, major rejections, major resistance levels above that show you, okay, this trade could be over now. It's rejecting levels above, and that's when I get out of half or the entire position. So in trades when it is clear that the trend you are profiting is over. In any sector, trade the leading stock, the one that shows the strongest trend. Very important. And that's called relative strength. So, one of the ways that I approach trading is I'm looking for all the technicals and the confluence combination of signals, but one of those is Is this stock stronger than the rest of the market for a long? Is this stock weaker than the rest of the market for a short? Never average losses, 100% true. I like to make one entry. If it keeps going down, I don't add more to it. Markets are never wrong. Opinions often are. How many times this year or over the last year have you had people say, "Oh, we're going to new lows," or "Oh, we're going to new highs"? Everyone has an opinion. Opinions, everyone has one, right? But the market is never wrong, and that's the beauty about trading technicals. Is the technicals, the rejections of certain levels, is the market telling you it does not like that? So be careful of people giving you their opinions of where the market's going to go. Trade what the market is doing. The highest profits are made in trades that show a profit right from the start. That is so true. I have noticed that in my 28 years of trading. And the ones that take off right away, like that DIA trade that I had or the short trade on Home Depot, they moved quickly, immediately my way. And, you know, reason is because I was patient and waited for those levels of rejections. If you wait for those levels of rejections, both to the upside for a short and downside for a long, very often they will immediately go in. And of course, the best trades you can ever have are the ones that go your way immediately. And that's why risk to reward is so important. As long as the stock is acting right and the market is right, do not be in a hurry to take profits. That's true. It goes back to being patient with your winners, being very impatient with your losers. Never buy a stock because it has had a big decline from its previous high. Yeah, I agree with that, but again, it comes back to levels. Don't become an involuntary investor by holding onto a stock whose price has fallen. That's right. You need a process. You need if-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. Or in other words, you have to have a process. If it gets to 65 RSI level and then it closes below the 5, just out. But just don't hold on and let the just market. You have these boom and bust cycles. Wishful thinking must be banished. 100%. I think that one is pretty self-explanatory. Back to a process. It is much easier to watch a few stocks than many. That's true. It takes your focus away. That's why I have a master watch list. And on the weekends, I go through when the market's closed, things are calm, and I identify, hey, these look good. These stocks look good if they get to this price. If they get to that price, great. I'll take them. If they don't, I'll look for another market. Patterns repeat because human nature hasn't changed for thousands of years. And that's what you're looking at when you're looking at patterns on your charts. You're basically trading human behavior, and that's why these patterns repeat. So anyway, hopefully that was helpful for you. Thank you, Black Swan, for posting that, and please follow Black Swan, founder of Trade Hubble, over on Twitter. All right, now before we take a look at potential trades for next week, again, I want to do a quick poem for my friend Frank. You can follow Frank over at FrancoD over on Twitter. Today's market poem, let's see what Frank has to say. Measure your risk. Know what you can handle. Study the charts, each line and every candle. Go easy. There's no need to scramble. The biggest mistakes are made when you start to gamble. Isn't that true? Let's break this down. Measure your risk. You know what you can handle. Well, that dovetails perfectly with position sizing based upon volatility, like I discussed earlier. So measure your risk. Know what you can handle. Study the charts, each line and every candle. That's what we do. That's what we're doing today. That's what I'm going to do when I show you the potential trades for next week. Go easy. There's no need to scramble. It's true. Trading is a long-term endeavor. It's a marathon. It is not a sprint, so go easy. The biggest mistakes are made when you start to gamble. That's so true. If you've been in a losing period, if you've been in a drawdown, you get frustrated, then you start to gamble. Not going to get it done for you. I can tell you, trading gods do not like that. They like nice, calm, methodical approaches to trading. And, with the course, that the one-on-one course that I teach you all of these things, right? So that you don't need to gamble. So one more time, measure your risk, know what you can handle, study the charts, each line and every candle. Go easy. There's no need to scramble. The biggest mistakes are made when you start to gamble. Thank you, Frank. Hope you're doing well, my friend. Miss hanging out with you every day on the live stream. But please follow Frank at FrancoD over on Twitter. All right, everybody. So I've got some decent things to take a look at now. As I go through here, these are the trades that I'm looking for. Again, it's a patience game. It's waiting for your market to get to the level that you've identified. So hopefully this will be helpful for you. Here is Advanced Micro Devices. Now, I have two potential entries next week. Now, one of them is time sensitive. This particular trade could only happen on Monday. We're starting to form a V2 here, potential V2. Here is bar 1. Bar 2 goes below bar 1's low. If Monday, and only Monday, we close above bar 1's close of 92.09, I will get long because this will be a V2 in the value zone. This is a return to value, potential V1, V2. Then this is what I teach in my course, one of my very favorite approaches. They don't happen often, but when they do, they're high probability trades. So we were above the value zone. Value zone's these two green lines here. Anywhere in here is the value zone. We've come back into the value zone. We've had some sideways motion. We poked our head below, which is okay. But if Monday we close above 92.09, not too far above, because then the risk to reward ratio is not that great. But if we have a nice gentle close above bar 1's close here, we'll have a return to value V2, which is a very good risk to reward ratio. So again, for me on Monday, if we close above 92.09, in a nice gentle way that's back in the value zone, then that is what I'm looking for Monday only. Now, alternatively, if we go lower, orange line here is the 300-day moving average. Very good risk to reward ratio if it rejects it. So if we come down, bounce at the 300, or intraday go below and then close back above, or alternatively close below and then close back above, that is a very good level to buy. I drew the green line here at the 300. Let's see what that looks like on the higher time frame. All right, higher time frame, 1 ATR channel. That is a legitimate level of support. So I'm looking for the entry on the daily with a rejection of the 300. But that level, green line, dovetails beautifully with support on the weekly. I like to look, if I'm taking a trade on the daily, I want to look to the higher time frame on the weekly as well to see if there's some support there. So two potentials next week for me for AMD. If we close above 92.09 on Monday, I will get long AMD. Alternatively, if we come back down, bounce, intraday reject, or close under or over the 300, that will get me long as well. Alibaba. All right, Alibaba's had a strong move. Don't want to buy up here. 200-day moving average makes a lot of sense for me next week for Alibaba. Don't know if it's going to get there, but if it does get there, it gives me a good risk to reward ratio. Here's the green line. Let's look to the weekly. Green line doesn't line up perfectly, but it's in the value zone. It's inside this big up bar. I like buying dips inside of a big up bar, so that makes sense on the weekly. So 200-day moving average. Also, the 250 is also another place that I could take a look at. So the 250, any bounce, intraday rejection, or close under over the 250, or alternatively the 200, I would get long Alibaba. And it makes sense because we had a big up move. Yes, we've had some selling, but it's normal that we have a pullback into a major support level like the 250 or the 200. So that's what I'm looking for on Alibaba. Disney. Okay, Disney. I am looking for a short on Disney. 200-day moving average has offered some significant resistance. You can see we were above it, then closed below it, above it, then closed below it. Came back up here, touched it. Could have shorted this on Thursday, but I didn't take that trade. But the key here is this big down bar on this high volume. Yes, there's a bounce here, but I believe it's going to be very difficult for Disney to get above this high because of the huge reversal and bearish engulfing bar that we had here. So what's the key level? The key level is the 200 next week. If we come up intraday, reject it, have a bounce to the downside above it, or it close over back under the 200, I believe that gives a very good level. And let's take a look on the higher time frame. That 200 dovetails with the 50-week moving average on the weekly. See? So any rejection of the 200 next week to the upside, I would get short Disney. Gold. All right, everybody. This is important. You see, I've highlighted this bar here in blue. This is called an abandoned baby. Kind of a strange word, right? But they're very, very strong. And I'm going to show you some examples of this to put it in perspective. An abandoned baby is when you have a bar with a gap to the left. You can see there's clearly a gap down, gap up. There's a gap to the left. And we now have a gap down to the right. See how it's hanging out here in space with a gap to the left and the gap to the right? This is very bearish for gold, extremely bearish for gold. As a matter of fact, when I took that short silver trade, this is one of the reasons confirming why I took the trade. Now, I'm not going to take the trade here because the risk to reward ratio isn't good. But what I'm waiting for next week, if we come back up and we test the low of Thursday, right here. If we come back up, test that, reject it, I will get short gold. My end of day stop will be a close above this high. But let me show you some examples of abandoned babies on some other stocks. UUP, dollar. Let's go back in time. Look at this. Abandoned baby. Looks very similar to gold, doesn't it? Gap to the left, gap to the right. Was that a good place to short? I think so. Look at that. Massive to the downside. These are strong, strong signals. Abandoned babies or island reversals. Gap to the left, gap to the right. Boy, was that strong. Interestingly enough, look what happened on Friday. We have a bullish abandoned baby. We have the gap to the left, gap to the right. That is very, very bullish. I didn't buy the dollar, but the dollar has a negative correlation to the market right now. Most likely, you remember when I said that I'm bearish on the market? Well, these are the reasons. These are what are telling me. This is one of the reasons that I am bearish, because this is a very bullish signal. The gap to the left, gap to the right. The more the dollar goes up, most likely the market is going to go down. So this is a very strong buy signal on the dollar. Let's look at bonds. Show you some other examples. Look at this abandoned baby here. Gap to the left, gap to the right. Very bullish. Was it bullish? It certainly was bullish, wasn't it? So back to gold. Massive abandoned baby here. Now, I'm not going to just take the trade. Like I said, I'd like to see some pullback or retracement back up to test the low of Thursday. I would really get short here based upon that. All right, VIX. Well, VIX, I mean, what an amazing move up on the banking crisis and then straight down. Well, let's take a look at the weekly. Weekly, we have a double bottom bullish divergence. Here we have a low with deep red MACD bars. We rallied strongly. Now we are lower than this low. No red bars whatsoever. This is called a double bottom with a bullish divergence. This is what I learned from studying one-on-one with Dr. Alexander Elder. This is starting to become very bullish for me. It doesn't look bullish, but it's bullish to me because of the double bottoms bullish divergences. So on the daily time frame, I need an entry signal We're at a 35.55 RSI. Simply a rejection of the 30 RSI would get me long the VIX, especially based upon the higher time frame of this double bottom bullish divergence. So simply stated, on VIX, if we get an under 30 over 30, I would get long VIX. And then last but not least, on the daily is XLV. This is healthcare. Where's the level that I'm looking for? Anyone can guess? It's the 200-day moving average. Is it at the 200? No. If it gets here and rejects the 200 next week, I will certainly buy XLV. If it doesn't, then I'll just move on to another market. I drew the line here at the 200. Let's see what that dovetails on the weekly. Is there any support at that green line on the weekly? There sure is. A whole lot of it. We have the 50 SMA. We have the 10 EMA. Nice confluence of support here on the weekly where the line is that was drawn on the daily. So again, it's just patience. If it gets down to the 200, yeah, I will buy it. If it rejects the 200, I will buy it. If it keeps going up, great. If it doesn't get there, I won't take it. And that's why it's important, everyone, to be patient. Do your homework on the weekend. Identify these levels like we've just done here. And so if we come back down to the 200, I will get long. So real quick recap. On AMD, on the daily, Monday and Monday only, if we close above Thursday's close at 92.09, I get long AMD. If it keeps moving down, I'm looking for a rejection of the 300. So Monday, if we close above 92.09, I get long with a return to value V2. Or if it goes down and rejects the 300, I get long next week, AMD. Alibaba, waiting for a pullback to the 250 or the 200. Rejection of the 250 or 200. Walt Disney, short, looking for it to go up, reject that 200 for a short. Gold, very important signal. Island reversal, abandoned baby, whatever you want to call it. Looking for a retest of Thursday's low at 189. Some kind of rejection of 189. I get short. VIX, looking for an under 30 over 30 RSI. We're at 35.55 now. And healthcare, pullback to the 200-day moving average. If it doesn't get there, no problem. All right, those are the dailies for next week. Let's look at weeklies. And again, weeklies, this is a trade I would take on a Friday. All right, I've been talking about Etsy for a few weeks. Here's the 300-week moving averages. This is what I'm looking for. I'm just looking for a bounce at the 300 on next Friday or a rejection of the 300 next Friday. I drew the line here at the 300. Let's look at the higher time frame, see if there's any support on the monthly inside the big up bar. Whenever we have an up bar that's larger than 1.5 ATRs, larger than 1 ATR, I consider that a large range bar. This green line, which is the weekly, is still inside that bar. I like that confirmation on the monthly. On the weekly, simply waiting for rejection to 300. Now, looks scary. It's gone down. But again, like I mentioned earlier, buying fear is one of the best ways to have a good trade. Buy when no one wants, but buying with rules, right? And my rule is the 300. I mean, that trade I showed you on IWM, I bought that at the 300. Was scary, kind of held my nose and had to buy it, but it's a level, right? So I'm just looking for some kind of bounce or intra-week rejection of the 300. I like that very much. Don't know if it will get there, but if it does, I'll enter the trade. India. Okay, this is the India ETF. We've had a close under, close over the 200, moving up nicely. Nothing to do here, but if it comes back down with a bounce or intra-week rejection at the 200, I would buy it. I drew the line here at the 200 on the weeklies. Let's see what that dovetails on the monthly. Monthly support of the 50-month below it, so I like it. And here's a V1, incidentally. So next week, simply said, if we have a bounce or intra-week rejection of the 200, giving me a good risk-to-reward ratio, I would consider getting along INDA. Pfizer. All right, well, Pfizer key level here, 200-week moving average. We are above it. Not going to buy it here, but next week, if we come down, have a bounce of the 200 or an intra-week rejection of the 200, I would get long. If I did get long, earnings are coming up fairly soon, about a month later, so I would only be able to stay into it up until earnings. So some kind of bounce or intra-week rejection at the 200 is my key level. I drew the green line here. Let's take a look at the weekly. Is there support? Yeah. Support of the 50-month moving average. The dollar. All right. Well, we talked about the dollar. We talked about the dollar with this abandoned baby here. Very, very bullish, which I believe is bearish for the market, honestly. But as far as a weekly trade on UUP, what am I looking at? Well, I'd be looking at this 100-week moving average. If we got down to the 100-week moving average, we would also be in the low 30 RSI levels. And in addition to that, we would have a double bottom and a bullish divergence. Here is the first bottom, deep red MACD bars. We rally into some green. If we come back down to this to the 100-week moving average, we would have a double bottom with a bullish divergence and a low RSI level. I drew the green line here for the weekly. Let's see what that dovetails on the monthly. Just straight in the value zone, which I like. So some kind of bounce or intra-week rejection at the 100-week moving average is what I'm looking for, because we would have a double bottom, bullish divergence, and low RSI levels. And VIX, we mentioned this before, beautiful double bottom bullish divergence at this point. But just because we have a double bottom bullish divergence, we don't just buy, we still need to have some kind of trigger, and the trigger would be an under 30, over 30. So quick recap on the weeklies. Etsy looking for a rejection of the 300-week moving average by next Friday. INDA, some kind of rejection or bounce at the 200 next Friday. Pfizer, again, some kind of rejection or bounce of the 200. The dollar, rejection of the 100-week moving average. And the VIX, some kind of rejection of the 30 RSI. So that's what I've got for next week, both on the dailies and the weeklies. And important to just be patient. If none of those levels get triggered, then I just don't make the trade. That's just all there is to it. So, I've mentioned several times about the course that I teach. It's a wonderful course, everyone. If you really want to learn a skill, if you really want to learn a skill that you can use for the rest of your life on multiple time frames with trading, I think I'm your guy. I've taught many people from around the world, great reviews, and it's a 15-hour course. Each session is 3 hours, and we have 5 sessions. That's where you get the 15 total hours. And I teach you step-by-step all 5 of the different trading approaches that I use. We do a lot of simulations. Before I let you go, I make sure that I know that you know exactly everything that I've taught you. The course does cost $1,750, but it's worth every penny. So if you are interested in studying with me, my email is in the link of this YouTube video. Just send me an email, say, Greg, potentially interested in taking your course. I will reply, say, hey, great, thanks for saying hello. Let's set up a Skype call. Skype call is free, everybody. It's not a sales call. I just want to learn more about you, what you're looking for, your trading goals, your trading challenges, and it's a great time for you to ask me any questions about the course. When we're done with the call, think about it as long as you want. And then one day, if you decide, hey, today's the day, I really want to learn this skill, email me back. We'll set up the course and we'll get rolling, and you'll be glad that you did. If you like online courses, I also have a great online course available at udemy.com. The link is in the link of this YouTube video. It's a great course. It's very affordable. It only costs between $12 and $15. But don't let the low price fool you. There's great content there. And in that video, or in that course, I show you exactly how to trade the deep dip buy approach. There are 26 videos, 15 study guides, 9.5 hours of videos. Pretty good, right? For $12 or $15, and you will learn a lot. So the link is in the description. If you like today's podcast, I would certainly appreciate it if you could hit the thumbs up button. It does help the channel out, lets YouTube know there's some valuable content here. And I think the concepts that I teach here are helpful for a lot of people. And there are a lot of people that need help with trading. So you could help me help them just by hitting the thumbs up button before you get on with your weekend. I would appreciate that. And then lastly, and always most importantly, please try to do something nice for another human being today. It would just make the world a better place if we could all do one nice thing, one random act of kindness for another human being. And I am a huge animal lover, and so I always try to, in addition to doing one nice thing for another human being, I like to do one nice thing for an animal each day. It would make the world a better place. It's good karma, and if you could do that, if you could consider doing that, I would appreciate it. So I hope you had a good trading week. I hope you have a good weekend. I appreciate you spending your time here. I hope it's helpful for you. If you have any questions about anything I've mentioned here, just go ahead, put them in the comments. I'll do my best to reply to them. But hope you have a wonderful weekend, and God willing, I will see you next weekend, and we'll see how these trades worked out. We'll see if any of these potential trades that I mentioned here get triggered, and if they do, I will take them. And that's about it. So thank you so much for tuning in, everyone, and have a good week ahead. And on the way out here, I have to run the U.S. legal disclaimer. Have a good one. Have a great week. Talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.